listening to Ready, Set, Go Real Estate Investing Podcast, presented by Brandon Elliott. This show will be going over all aspects of real estate investing and is intended to educate, motivate, and prepare you to take action on your first or next real estate investment. For more information, please visit BrandonElliottInvestments.com. Thank you for listening and enjoy.
Welcome back, everyone, to Ready, Set, Go Real Estate Investing Podcast. I am with my friend Patrick today. He jumped into real estate back in 2006, 2007, got kind of wiped out from the crash back in 2008 and started bouncing back into real estate years later. Nowadays has passive investing mastery, teaching people really about the non-correlated investments and how to actually become more recession resilient at the end of the day. For anybody out there that doesn't know more about who you are, where you're from, your story, and how you got to this point, do you mind just giving us that 10,000 foot view?
Yeah, sure. Thanks for having me, Brandon. I think like most individuals probably listening to your podcast, they're successful professionals making a great income and wondering where to invest it for their long-term financial health. And I was one of those. I was a high-tech machine design, automation, robotics guy, and things were going really well. I talked to, right out of college, I talked to the founder of the automation firm I was working for and asked him, hey, where should I invest? And I thought he was going to be, go to this startup or that company because we have like the inside track. And he was like, I take all my money in high tech and I dump it in real estate and other alternatives outside of the stock market. What? He goes, yep, my only regret is not investing more sooner. So that's what got me on the path. And, being, snot-nosed engineer, thinking I'm, bigger than life. And, I invested big, heavy, quickly into what I soon learned were very risky new development, pre-development, and everything. I was battered, beaten, and bruised. I made it, struggled for a couple years to recover. Yeah. So I was a successful engineer, so I made my way back.
And then, so years later, after kind of recovering, then what? Why'd you get back into the game?
So when I started, I got a dual master's degree. I went and got an MBA and a master's in engineering while working full time. And then I traded to a smaller company. So I was a bigger fish, a director position, another machine design firm. And I started making some bonuses again. And I was like, well, what am I going to do in this? So I followed the breadcrumbs of the wealthy again. And that did lead me back to alternatives, right? Not the latest startup. And I was doing really cool projects with brand new gizmos and gadgets, but I was watching a lot of those startups fail. And I've seen how the stock market and real estate can go for a ride. So I started looking for recession resilient investments. Mm-hmm. And that had more stability than Northern California, and found some single family homes in Houston. And the downturns that had stayed pretty tried and true. Started buying the single family homes there, renovating, refinancing, renting, and repeating. And then from there, I had a pretty good side gig that pretty much I was moonlighting while doing my engineering stuff. It was working, but it was brutal, taking up all my time. So I stopped doing that when I went to go marry my wife, to carve out time for that. And then when I came back to it, I traded up to larger apartments. Then realized, well, I got into this to diversify, so I need to get into some and other things other than real estate, because here I am in a situation and I'm almost all in real estate again. So we got into energy, we've got into debt, private credit, and we're in legal funding as well, which is a whole nother thing and a completely different allocation that doesn't rise and fall with the rest of our portfolio.
I love that. So what year did you get married with your wife? And then you're in Southern California?
Yeah, we were in Southern California at the time. That would be in 2016.
Is that San Diego or LA?
Interesting. So she's from Beijing and she got a scholarship. She wanted to go work at Disney. She got a scholarship at Cal Arts in kind of North Los Angeles, up in the hills. It's the school Disney started. And then she got her master's degree there in animation producing and then promptly started at Disney. And we moved just right down the road from Disney Studios in Burbank, where we got married so she could ride her beach cruiser bike to work.
Cool.
That's where we were at the time.
Nice. And what year?
We got married in 2016.
2016. Awesome. So at this point, you started looking into diversifying again and kind of spreading out a little bit. At this point, you weren't doing anything active. This is all just lending out, putting your high income W-2 to work because it's probably driving you crazy seeing it just sit in the bank, dwindling away. and not actually, making a return off of it. So you start looking for other alternatives, and which platforms did you start finding? You started creating this company as well on the side, correct?
Yeah. So we have a company that does mostly multifamily apartment buildings. And then we have Passive Investing Mastery that focuses more in alternative allocations and educates on alternatives. And so within Passive Investing Mastery right now, that's where we're doing legal finance, and which is super cool, but we're also doing debt. We're doing private credit, and we're doing acquisitions in commercial real estate. And those are opportunistic because just like how residential real estate took a dive in 2009 and 10, which took me down with it, right now is actually the best time of my life to buy commercial real estate. There's a bunch of performing properties with financially distressed operators that have just been raked over the coals through COVID, delinquencies, eviction moratoriums. They've seen inflation increase their payroll, increase their materials costs for renovations and constructions. They've seen insurance double and triple in some markets. And on top of all that, interest rates, which is what we're talking about, right? Which devalue properties. These are properties that are really strong. These are good assets, and typically people would lend on those 6, 7, 8%. But right now, with banks on the sidelines, our lending company can give these operators more time, but lend 12, 13, 14% at a low loan to value on current value, which provides great returns from a debt product. That's really cool, opportunistic. Or in our acquisitions fund, we can just buy it quickly in cash and be a source of release for those operators who don't need more time. They just want out and capture value right now, and then quickly trade up and do that as quickly as we can while we're still in this great buying opportunity.
I love that. So why not just do it for yourself? Like you were doing it for yourself for a little bit, and then you decided to kind of branch out, help out more people with this, where like it sounds like you have some passion behind this, some core values that you guys kind of stand behind. What prompted you to help out more people and bring more people along the ride with you?
Well, I was very apprehensive to do so with my first experience, having lost everything. But after I got into my next experience, started using all my own money to invest in single family apartments or single family residences, and that working very well, but seeing how doing it all on my own while having a demanding job just took over. And it caused a lot of pain and anguish to the point where my wife was there for my very last single family closing. And I said, look, my soon-to-be and potential soon-to-be wife. And I said, hey, I'm going to take a break from this. This is the last one. We were in Chinatown in LA, and she was there and the notary was there, and we signed. And then I just took a break after that. And then we took us 2.5 years to get married. And then I realized in order to build a sustainable scaling portfolio, I need a partner. I need to partner with different operators that are experts in different regions, that are local with a track record. I need to partner with different capital sources, right? So we can get into larger assets that are lower risk. And my calculus was got to be at least 80 units to have on-site property management, on-site leasing, on-site maintenance, and to get, the better quality loans. And so that was our first one was 86 units that we partnered with. And, we invested with other people that were operating as well. So we took less of the deal, but then we partnered with capital partners. But then again, I've always been somebody that, as you said, wanted to take people along for the ride. I mean, 12 years before COVID, just for an example, for my birthday, which is actually coming up on St. Patrick's Day here, but I took a motor coach to the wine country because I love wine, and I would take between 30 and 50 people every year, and we'd spend 3 nights up in the wine country for my birthday. And COVID obviously just completely destroyed that, and the wineries have no longer allowed buses or even 15 passenger vans. So that's the thing of the past, unfortunately. But I love taking people. I love getting passionate about things, especially when it's important, because really the mission at Passive Investing Mastery is to help our investors build mastery in the art of passive alternative investing.
Yeah.
This is what truly builds that comfort in your long-term wealth and legacy. It's not being all in the stock market, Bitcoin, or real estate. In fact, when you get really good and comfortable at something, that's when you get over-indexed in that one thing and you have this fear in the back of your head. What if that one thing? And then if you really look at the way that the wealthy allocate, they have allocations in real estate, 20, 25, 30%. But then where's the rest of it? And we show these charts on our decks. And what are these other investments that don't rise and fall with the stock market? Like Don't rise and fall with energy, interest rates. Don't rise and fall with gold. Don't rise and fall with the broader markets. Well, those are what we call non-correlated investments, ones that don't rise and fall together. And healthcare, education. People need healthcare in downturns. People need education and upskilling in downturns. People need plumbers. They need HVAC. They need CPAs. They need attorneys. And these kinds of industries are great ones. They're a little novel, a little harder to access for the typical accredited investor. They're heavily sought after by larger institutions, hedge funds, private equity firms. But our firm is really about not only educating on all the different options, but also sponsoring specific non-correlated investments, making them accessible to accredited investors so people can start allocating into these assets. Like the legal industry, just steady, tried and true growth over time. Doesn't care what anything else is going on in the world. Doesn't care about interest rates, gold, real estate, stock, but just steady, tried and true growth in the legal industry. You can allocate there as well. And you can go to bed knowing, hey, at least I have something out there that's not going to go up or down with the rest of my portfolio. And that's not just financial independence, but that's financial independence with stability, foundations, and broader markets. Does that make sense?
Yeah. So you're setting up these funds, raising capital for them, and then you're putting it in the legal space. In what form? Like how does that work with? Because this is the first time I've ever actually heard this, and I know you explained it prior, but for the listeners out there to actually like soak it in, explain what this looks like for the legal standpoint, for litigation fund, for that example.
Well, it's just like any asset-backed lending strategy. You're familiar with buying a car and getting a loan. You're familiar with buying a house and getting a loan. And in all those cases, just like when you're lending to a real estate operator and you're saying, hey, Mr. Operator, I'll give you some funds, but what is it for? You're either buying a property, you're acquiring a property, or you're improving a property. And the intent is that you're the service you're providing to the community is you're housing a tenant, right? And the legal industry, you've got to find, it's a very simple industry. There's not a lot going on there. There's attorneys, they have hourly rates, they have staff, they have filing fees, court fees, they need to fund this. And not all of their customers can fund it. Not all their customers can buy their own representation. And so there's a large amount of attorneys out there that work under either pro bono for free, which isn't what we do, or a contingency fee, meaning that they'll put a contract together saying, hey, look, your case is a really good case, or it's similar to these 1,000 other people that I'm already representing. And so let's tack you on, let's add you on, and let's get a contingency fee-based contract so that when we settle this, I'll get paid on the back end. And in that way, we can lend to attorneys working under contingency and enable this contingency fee-based industry to either acquire more claimants, acquire more clients, increase their docket size, as they call it, make themselves bigger and meaner to some big defendant that they're going after and trying to get to settle faster, and then increase the amount of pie of income they'll get in a settlement. Or we can either help them acquire, or the operating expenses to get it across the finish line, hourly rates, expert testimony fees, all those things, to get it across the finish line to settlement, and then participate in the settlement fees. And so that's the structure, all the same mechanisms, the asset backed, the lien, the financing agreement, they're the same of any kind of asset backed lending structure.
I love that. Talk to me. What do the returns look like on something like that? And I know there's a lot of certain regulations and so forth, but I'm just curious, like rough range of how long have you guys had this fund open? And I'm just curious some returns, because I've never heard of something like this. It's one of its kind in my world. And so I love hearing about these creative different spins to it. It sounds like a complete no brainer.
Well, it's not one of a kind. To be clear,
okay.
We're providing access to accredited investors. That's a little unique. Usually the buyers are 5, 10, 20 million, and it is a bit of a novel asset class. So there's fewer attorneys engaging in contingency fee than there are real estate operators. But it's been around since 1910 was the first case of what we call third-party funding of litigation, or legal litigation funding, or the litigation finance. And it was when a bunch of farmed individuals got together and said, hey man, you know what, we're smoking these cigarettes. They say they're good for us. But I don't know if that's true because we're all dying horrific deaths, right? And it was in that case that some people got together and funded the representation against American tobacco. And they will.
Wow. Wow.
I mean, we're one of those actual attorneys. I mean, not the actual attorney, but the firm is one of the firms actually that is representing other people in new, what we call mass torts or mass, when there's a mass amount of people harmed and there's a harm or injustice done. And they're still there representing. They're amongst some of the leadership firms that are helping people that were disadvantaged, that were harmed. I mean, some examples of these are sexual assault cases. I mean, we're not involved in the Catholic Church or the Boy Scouts, but that is an example. What we are involved with is it's like the LA Juvenile Detention Center. It's a really bad one where there was a lot of harmed individuals in that case, and so we're representing some people that were harmed in those. There are cases like Roundup, where there was landscapers and farmers that were exposed to Roundup continuously, and Bayer, was Monsanto, actually before it had EPA reports saying it was safe. Well, those were been retracted.
Yes.
And they're punitive damages. And so now there's a lot of people struggling. And so there's a couple hundred harmed individuals that are in our fund that we're helping represent. Then there's like contaminated water at Camp Lejeune. This is a heartbreaking one. For 17 years, the government fed our military. It's a Marine base where people train to go to war. Their actual Marines, their families, the civilians on that base for 17 years drank contaminated water. The government responsibility for it, liability, causality. They passed a law, the Camp Lejeune Relief Act. They put the U.S. Judgment Fund is to pay these claims out. And then they put a grid together showing, hey, based on how long you were there and what your disease was, here's what you can settle for today. Or over the next coming years, we're going to roll out with specific symptoms what's a more fair settlement. And so there's, I think, 1,800 Camp Lejeune claimants we have. We're representing in our fund. We're funding an attorney to represent military guys, right? Lots of those examples that we can go into.
I love that. So on the investor side, though, the investors that actually participate in those funds, what does the return look like for those?
So those funds, plural. So just like any kind of investment, there are more risky investments and there are lower risk investments. So like if you're in oil and gas and you're super early on, you are wildcatting and you can get huge 30x returns, right? If you're an angel investor, you can get 300x returns. If you're in a pre-development, like I was in 2009, you can get many X returns or lose it all, like guidance, right? So we are kind of in that different realm where it's very late staged towards settlement, right? Where it's already gone into the courts. There's already oftentimes settlement talks, or there's other cases that have settled. You got a really good feel. We can have a valuation specialist that evaluates law firms that could come in and verify the collateral's there. We can put a lien and we can get a real clear understanding of underwriting. And so that means we're taking a lower risk approach to being as close as we can to settlement, advancing kind of the dollars, not at the very speculative side, but at the end. And instead of getting like 30x returns, we're aiming for like 20 or 30% IRRs, right? Over the course of the fund.
Now, if the court process is already in the towards the end process of it, why would they need other investors' capital to actually, is that to get some kind of data or some kind of information to be able to really drive it home and finish the negotiations, or what would that look like?
So some of these will go on for, in the early stages, a while. Like people started working on Camp Lejeune like 10 years ago, but it didn't really become what we call like a filed case until a few years back. And so typically what we like mass torts, when something's kind of like, okay, we're going to hear all these individual cases together, not class action. We don't do class action. That's different. People really make anything on class actions, like $50, $80. But these mass torts, these are real meaningful settlements. So 100, 400,000 per claimant really makes a meaningful settlement. Those usually last like 7 years or so. And so, but once you get into the cases and then they start trying these cases and they start allowing expert testimony, they start seeing that it's going to happen. And you also got to realize that 90% of civil cases sell. It's not really so much a game of win-loss much, especially when you're late stage. There's always some risk there, but especially when you're late stage like this. But in our case, those attorneys they have a lot of skin in the game.
Sure.
It's kind of like a developer that used their own money to, entitle the land and then get the first subdivision, second subdivision. And now they're like, okay, here's the third subdivision. We need some more money to get us across the finish line. We don't have enough to get another 100 properties on here. But if we get a loan for that, we'll be able to do that, which will make our pie bigger, right? Same thing with these attorneys. They don't have enough money they can add as many people as they can to their docket, and they can try more and more people simultaneously, which doesn't cost a lot more than how many they're doing now. Just have to go through all the motions already, so that we can help them with marketing expenses to try and keep their marketing mill going, where they're adding more and more people to their client list. Or we can help them with that later stage. Here's the funding you need to get this across the finish line. And either way, we take collateral. We take, a lien on the actual agreements or the sharing of fees that allow us to profit along with them from the settlement.
Yeah. And so nowadays, within passive investing mastery, you are showing new asset classes, new investing opportunities on a regular basis to folks that participate in that and that are kind of in your wheelhouse, your community, correct? What does that look like for you guys on an ongoing basis?
Yeah, so we have investments, but my whole kind of my passion is to educate those hardworking professionals out there. I used to be a contractor with Lockheed and Raytheon and Google and Facebook and Abbott and Johnson & Johnson. All these crazy, amazing people.
Yeah.
None of them had any idea any of these. And these are R&D product designers, some of the smartest people on the planet. None of them, including me, had any idea that any of these other asset classes existed. So we have a form of passive investing mastery, which is a passion project for me, where instead of just me kind of on the side with you, Brandon, I know, here's the baseball cards of the alternative investing strategies. Let's, trade some of these. Here's where I want to show my whole hand. And then when we started doing that, we realized, look, this is a blue ocean of people, hardworking people, just need access to know all this stuff exists. And then I said, well, let's just pick up the whole deck. Let's do an entire alternative investing mastery series. Bi-weekly, we're going to host a brand new, completely different kind of investment strategy. And we've done, now we're at over 30. I think we're nearing 40. We've got everything from parking lots to laundromats to Bitcoin to angel investing, VC investing. We've got technology metals, precious metals. We've got bourbon barrel cask investing. We've got alcohol bev. How to buy an airplane for cash flow. Just the law. And we just did one on affordable housing strategy, single family, multifamily existing conversions and new construction, doing one on mobile home parks, manufactured homes, every single one we can think of. And I'm not listing them all, obviously, because there's too many.
Yeah. We'll be in all day. That's incredible.
Each time there's a panel, usually through 2 to 3 people that have been doing it for a long time. We kick it around. It's conversation based. We got 40 to 60 questions happening live. It's all live. And so people really get to be heard, get their questions answered. We give kind of a crash course and expose get it all out there as best we can. The financial IQ of America is so low, especially in the alt space. And I do believe it truly builds that resilience, especially today. Today you've got the situation where we just had a Fed rate hike. 11 of the last 14 of those ended in a bust. We got tariffs hitting right now. We see the market in a very volatile position. I really challenge, it's always the right time to be seeking investments which are not linked together, do not rise and fall together, especially non-correlated investments. And especially so today. The engineer in me probabilistically, this is a precarious time.
Yeah.
Allocating into a low position on a capital stack, like a debt investment or income fund, or allocating a completely different market like legal funding, or in the medical or receivables, or all these different kind of asset classes we talk about, those can really help build more stability, right? So you're not so fearful of that downturn like I was and like I experienced. And maybe if things crash again, you lose a butt, but you don't lose your own shirt.
Yeah, that's good. I like that. Talk to me about the market right now. You know, you're dropping some hints around it, but overall, and I won't hold you to it, but you know, nobody's got the crystal ball. But what do you think the future is going to hold within the next 6 to 12 months, and then even the next 2 years in the market space right now? Like you were just mentioning, there's always opportunities somewhere, but what do you actually think the market's going to hold?
Unfortunately, I think interest rates are going to stay flat, mostly, significantly so. So the distress in the real estate market is not, especially commercial real estate market, it's not going to recover soon. So I think there's a long throw right now for us to continue to be the source of relief and provide great returns through debt instruments, private credit, as well as commercial acquisitions. I do believe that we're in a very precarious situation. Like I said, it always makes sense to diversify your portfolio into different non-correlated investments, especially so now. The uncertainty margin of what's going to happen is dramatic. In past downturns, we were in similar situations, but we didn't have this explosive debt that we have today. And we didn't have the world's biggest economies betting against the dollar and fleeing away from the reserve currency, which helped stabilize us. So this is potentially one of the most precarious times in our nation's history. And we need to make sure, after printing trillions of dollars through COVID, we need to make sure that we're taking a hard look at that. So I tell investors, like, draw the pie chart. Like, you see our decks, we have pie charts from different sources. Draw the pie chart of where your allocations are. And then just get a sense of your confidence level for how those might perform. And just imagine like how much better you feel if you started adding different slices that don't perform along with those, right? Think about that.
Talk to me when it comes down to like the stock market right now or crypto, the signs showing that stocks may be crashing. Obviously, the next 2 weeks will kind of bring a little bit more ideas behind it. But what do you think the average American will do at that point? Do you think they'll switch over to bonds, or which obviously would bring down rates over time, or what are you thinking? You mentioned that you believe that rates will actually stay the same.
I don't think they're going to go down. I think they're going to stay mostly significantly flat, less 50 bips here or there. But my general sense is that when most people that I talk to, they have maybe a financial guy, they have a financial planner, they have their parents talking to them, whispering in their ear, and they're in the stock market. They've been really excited for a long time. Oh, I can't get out now. Oh, maybe I'm a little bit worried about a downturn, but it's higher than it's ever been. And then all of a sudden they wake up one day and they're down. Oh man, you know what? My unrealized gains were so high. I can't leave now. I'm taking a loss. Maybe not a loss on their invested principal, but a loss when their stack of chips got high and then fell again. And they're like, as soon as it rebounds, I'll take it out. I'll move it. I'll move it into a more stable portfolio. And then I talked to them, 2 years later, they're like, oh, it's on a tar right now. There's no way I can take it out right now. So they ride these waves, and it's very analogous to just going into a casino, right? And then you're just watching your stack of chips go up and down, and it goes up. Oh, you're on the ride until you can't. It turns out that the human condition is actually addicted to losing, the addiction. And so that stock market feeds that, and the whispering in the ear of the finance guys whose livelihood relies on you keeping all your funds in the stock market, and they're only trained in the stock market, that feeds that. And then our historic education that comes from our parents, that also feeds that. So it's never a good time to pull outside of that. And so that's what I think is going to happen. It's going to perpetuate this same wild ride that people are on. And that's why the interrupt is the attempt to try and get alternative education out there. Because if you look at somebody gambling, from the outside, you're like, man, that's stupid. He's going to lose it all, right? He's going to lose it. Like, he could leave right now ahead, but he just remembers when that stack is here. Sometimes you got to realize you're just at the wrong table, or you got to take some of those gains and move that from your IRA to a self-directed version, or from your cash to a self-directed version, and move it to somewhere else that doesn't take that same curve, so you don't end up down across your portfolio like I was all at once.
Yeah. What other learning curves have you seen possibly with other investors or yourself the last few years experiencing?
Learning curve that I've experienced as well as other investors over the last few years. Well, I think that, multifamily apartment buildings was on a tar, right, for a long time. And we saw just a black swan event with COVID happen. And then we saw the printing of money, and then we saw inflation hit with interest rates skyrocketing more so than they have been. So
Yeah.
it's a really tough time. A lot of strong performing assets that, we're talking like this multiple apartment buildings had been like the generations long store of wealth. And we found a crippling effect in their ability to maintain their value. It's a challenge, right? And so I think that's been a wake up call for a lot of people where they just like in their stock portfolio, they rode this stack higher and higher, allocated more and more and more. And in apartment buildings, and they did the same. People saw great balanced cash flow, tax advantages, and growth, and they got more and more and more allocated. And then they found, turns out that's a cyclic market, right? Over allocation. When you get really comfortable into something, you get really good at something, then you get over index in that one thing. And it's that one thing that builds the instability that there is a fear in the back of your mind. What if, right? So the wake up call was a lot of investors realizing, I got to get back to the allocations. And if you follow the strategies, the truly wealthy, which
Sure.
put those inside of our deck, how they allocate the sovereign funds and the hedge funds and the private equity firms, they're seeking out putting allocations, maybe 20, 25% in real estate, maybe 27. They're seeking out these other assets, right? And that's what we're trying to unveil. And this is the right time for people it's always the right time. And this is the time when people can take a look at themselves and say, okay, we'll start allocating in some of these alternative ways. By the way, I'm not a financial advisor. I'm not a tax CPA accountant. I'm not an attorney. So this is not financial, tax, or legal advice. But I'm just a dude that's been around for a long time. I've seen a lot of things go up and down, and I've made a purpose of studying how the wealthy allocate and how those strategies have paid off over time. And I've talked to thousands of investors, so I have a pretty good feel for, the general sentiment out there.
How many investors do you have in some of these funds now?
I don't know the specific numbers. I think we have 500-600 individual investments last time I looked.
Yeah. Okay. And then are you still in the engineering role anymore in the job? No.
Unfortunately, no. I mean, I loved engineering and I had a great time doing it for a lot of years, but through having my son, I have a 2-year-old, and which has just been amazing. And through the success we've had elsewhere, it's given me the opportunity to focus purely on this investment stuff, and also for my wife to take a break from her feature-length animated film producing role that she was doing as well. And it's given us the opportunity to make some choices. And even right now, we're spending a couple years in Lulu.
Oh, that's awesome. I love it. Well, that's great, man. Talk to me. What does the future hold for you guys? And is there, for the average person out there that's looking to diversify and jump into some things? Obviously, again, disclosure, you're not a lawyer, CPA, any of that fun stuff. So it's not like investing advice. But where would you tell somebody to start checking out some due diligence and start preparing for?
I'd say jump into our mastery series, because you're going to get a lot of great education. We are, as a company, launching other assets that are non-correlated, similar to litigation funding. We have 2 or 3 completely non-correlated alternatives, ones that help to build more stability with less volatility, less kind of volatility that would be similar to the rest of your portfolio. So I'd say keep looking out for us. And I'd set up a meeting, depending upon what you're at, your portfolio, your comfort zone, where you want to go. Man, we've got like 50 different alternatives we track, and all over all kinds of great sponsors. And I can get you pointed in the right direction. If we're not the best stop, or if we're one of the stops, that's great. But one of the things that I love to do now is just talk to investors and help contribute and add value as much as I can. I also give a copy of my book away if you'd like for me to offer that to your listeners.
Yeah, I'd love that. Appreciate that.
So it's passiveinvestingmastery.com/book is the secret link. passiveinvestingmastery.com/book. And on that, there's a form. Make sure you put the name of this podcast there in the offer code, because we don't send it for free unless we know where you came from. We get some randoms and they don't send those out. But put in the name of the podcast down in the offer code, and you can either download the ebook or download the ebook, and I'll actually sign and ship out a copy. And it's cool. I wrote a whole chapter in it along with some other people that contributed chapters. I tell my whole story, high tech, losing it all, get single family apartments, alternatives, kind of the passive investing mastery mission. And if it helps to inspire anybody along the way, that's enough for me. And I just sign it and we ship it out for free.
That's so cool. Well, I appreciate that greatly. Guys, so definitely reach out to Patrick. He's got a wealth of knowledge. How can they get a hold of you any other way?
Yeah, so passiveinvestingmastery.com. There's a calendar link right there. If you scroll down on that homepage, you can set up a meeting with me. Or you can Patrick at passiveinvestingmastery.com.
Love it. And then, guys, if you want to get a hold of me, you can always do so on social media, on Instagram, on Brandon Elliott Investments, otherwise Credit Counsel Elite on Instagram. And if you guys are looking for more funding to be able to grow and scale your business, start a business, take it to your investment portfolio and grow and scale that, then check out creditcounselelite.com. That's www.creditcounselelite.com. We'll show you how to get up to 500,000. That's 2, 3, 4, or even up to 500K in new funding with interest rates as low as 0% in the form of funding and credit lines. If you guys are looking for more information on that and want to sit down and jump on a call, you can do so. With that being said, make sure you hit that subscribe button to Ready, Set, Go Real Estate Investing Podcast, and we will catch you on the next episode. Until then, guys, thanks so much. Patrick, appreciate you, brother. Till next time, God bless.
This has been another episode of Ready, Set, Go Real Estate Investing Podcast, brought to you by Brandon Elliott. For more information, please visit BrandonElliottInvestments.com. Also, please don't forget to like, share, and leave a comment below. Thanks again for joining. Until next time, God bless.